Welcome to Thoughts for the Week. Mo and Andrea here as per usual. This week's topic is hedge funds. So without further ado, Mo, tell us all about hedge funds. What are they and how do they differ from products that are already out in the investment market?
So hedge funds, Andrea, are more traditionally suited to institutional investment and what's also referred to as qualified investors, which are investors that have quite a strong knowledge of the market. And the reason for that is the minimums have traditionally been fairly high. The entry points also very difficult. And up until recently, you needed quite a lot of capital to actually invest into hedge funds. The biggest difference being inside the fund that hedge funds can invest short as well as long. So in traditional funds, a fund manager will go out and buy shares that he wants, buy bonds that he wants. Whereas in hedge funds, if they don't like something, they can actually take a position known as going short, where they actually sell something within the fund. And if that asset then loses money, they're actually making a profit. It's obviously a lot more complicated than that, but that's sort of the gist of how a hedge fund would differ to a normal unit trust or normal fund.
Okay, that makes sense. And, I guess that answers the question why people would use it, because it gives them the option of short and long investing.
Yeah. So you get different styles of hedge fund strategies. The primary ones being long short equity funds, where it's exactly what it means, where a hedge fund will be going long or buying shares that they really like and will be going short on shares or sector indexes that they don't like. Other ones are market neutral funds, which are funds that focus a lot more on risk rather than trying to create what's known as alpha. But you do get others, yeah. And the reason why you would go into them is to either in seek of higher return on risk or to create diversification.
And I'm assuming the different hedge funds will sit on a different space within the risk and return matrix.
Yeah. So interestingly, and it's why one does need to approach hedge funds with quite a lot of caution. In the traditional space, if you look at cash, you see cash as low risk. If you look at shares, you see shares as high risk. In hedge funds, it doesn't work like that. You need to actually consider the overall mandates. As an example, one of the hedge funds that I've used before, it's the highest risk hedge fund that I have access to, and it's a cash hedge fund. So it's a hedge fund that only invests into cash and bonds, and it's running at higher risk than other hedge funds that invest in shares. So it's actually more about how they manage the fund, how active they are, their risk mandates, the type of gross exposure they have, and that kind of stuff.
Okay, 100%. Just for people that might not know, when we talk about risk and return a matrix, that would obviously be an XY axis with a line running sort of like that, and risk and return on risk on one end, return on the other. Essentially, the more risk you take on, the higher return you should be getting.
That's right.
Yeah. So I just wanted to make the point of that. So look, for the average investor, I mean, everything you said sounds quite complicated. How would they have access to it?
So the average investor should not access hedge funds without advice, or if they're not a qualified investor, rather stay away. But interestingly, up until March, you needed about R1 million to access a normal sort of hedge fund out there. Whereas from the 1st of March now, they're allowing what's referred to as retail hedge funds. So it's hedge funds that have a lot more controls in place. So as an example, we talk about gross exposure. Gross exposure is just how much long plus how much short you have in the portfolio. So you might have 80% exposure on your equities long, but you might have 120% exposure short, and then you actually at 200% gross. In to normal hedge funds, there are much lower rules and a lot more relaxation in terms of exposure. Whereas in retail hedge funds, you can only go up to 200% gross exposure, which is a lot of help. And because they've been created for retail use, there are a lot more controls in place. So that's the biggest thing you just need to be careful of. That being said, if you do access retail hedge funds, the minimum on most of them are 50,000 Rand versus, and R1 million in non-traditional, in traditional hedge funds. And a lot of people are starting to access them in the retirement funds as well, because you can now also, according to Reg 28, which is regulations that allow certain asset classes into pension funds, you can actually go up to 10% now in pension funds into hedge funds.
Sure. So you're getting access to quite a diverse range of funds,
Yeah.
That are protected. So it's not like you can just go cowboy on the thing.
They're more protected, yes. So the mandates are a little bit more stringent, and you can also go through what I refer to as allocators, where they're actually selecting hedge funds within certain risk profiles on that curve that you mentioned, from cautious to high risk.
And do the restrictions affect alpha on the fund, or your investment return on the fund? And is it worth giving up that return for the protection?
Yeah, so the restrictions are more there to allow for retail hedge funds, so that if investors find themselves in these things, that they're not unknowingly taking on extreme volatility. So a lot of really great hedge funds out there are going 300, 400, 500% gross exposure, but everyone that is in that fund knows why they're in that fund, what the fund's about, how much risk it has, etc. Whereas because it's being opened up now to the retail market, they have to have those protections in place. And yes, it can absolutely affect the return, but it also controls the risk, which is great.
Yeah, that's awesome. From my side, look, I think it's always good to have a new entry into the market from a diversification point of view. So I'm glad that it has come around, and I'm glad that you've helped make it easier to understand why. Is there anything you'd like to add in addition to what we've already discussed?
No, I think in closing, it's always good to understand what is out there and what you can invest into. Hedge funds definitely fall in that space of, if you're not a qualified investor or an advisor, go get advice, because they work completely differently to the normal stuff out there. And that's it. I think, from my side, that's a great introduction to hedge funds, and to let people know that they've actually become a lot more available on the retail space.
Awesome. Thank you, Mo.
Thanks, Andrea.
And we'll chat next time. Thanks everyone for watching. If you enjoyed the content, please don't forget to give us a thumbs up and to subscribe to the channel. Just a disclaimer, these are our thoughts and opinions and not to be misconstrued as advice. Cheers.